All right. Hello, everyone, and welcome to our May Reg Brief. This is your monthly checkpoint for the important developments that happened in April. I am Robert Brosh, the Director of Regulatory Intelligence here at Ncontracts, and I am joined today by two people who are on top of all of the regulatory change that we are seeing across the country, across all of the regulators, and that is Cheryl Grizard, our Manager of Regulatory Tracking Operations, and Jenna Zakarowitz, our Regulatory Intelligence Counsel. So April was a packed month. I feel like I've said that for every month, or Stephanie has said that for every month. As always, we will go ahead and start with the developments that affect all financial institutions, that affect the industry as a whole, and then zero in on our banks, closely followed by our credit unions. So we're going to start off with some movement around anti-money laundering and countering the financing of terrorism, and that is because FinCEN did propose a rule to reform financial institution programs designed to fight illicit finance. And so first, this proposal requires financial institutions have a risk-based approach to compliance with the Bank Secrecy Act. And that really means that your program needs to align with and be commensurate with the types of products that you offer, the customers that you serve, the geographies that you operate in, and the distribution channels that you operate. So that means for financial institutions, this proposal is specifically calling on you to conduct periodic risk assessments that are dynamic and that are fit to your institution. Right? There's no more kind of dredging out the old BSA risk assessment at the beginning of the year, going through it, and then putting it away to gather dust until, that call comes in the next year to do it again. So the focus here is that your risk assessment should be run more frequently, and most importantly, when something changes within your institution. Maybe you have begun offering loan applications that can be completed and even approved completely online. And before, you required some degree of conversation with a loan originator in your office. Or maybe you have opened a new branch in a new state or merged with another financial institution, right? These are all major changes that require you to be dynamic with your BSA risk assessment, evaluate whether or not the risks that you have in place cover all of these new facets of your institution, and whether or not the controls that you have in place to mitigate those risks are truly effective. With risk assessments, FinCEN is also proposing that you have to incorporate their published AML CFT priorities. That probably sounds old because it is old. The last ones that we saw were published in 2021. Maybe as part of their final rule that they released, they will have new principles, but that's kind of a wait and see situation right now. For those of you who have NRISC, right, one of the benefits there is that you can tie those principles to your specific risks through the tagging that is within the situation or within the solution. That way it makes it easier to show your examiners come exam time. The proposal from FinCEN does also state that FinCEN is going to defer to financial institutions' decision-making when it comes to risk identification and resource allocation, with one important caveat, and that is as long as your decision-making and resource allocation is reasonable. In my mind, that means you have some sort of documented rationale for your program structure that you can show examiners and say, hey, this is how we made the determination of what our program is going to look like, and here is how we allocated time, money, and employees to upkeeping that program. Second, with this proposal, FinCEN is stressing a difference between just establishing your AML CFT program and implementing that program. So FinCEN did state that it is only going to pursue enforcement or significant supervisory action if your financial institution is engaged in significant or systemic failures in implementing your program. So it's no longer just a check the box approach to making sure that you say you have the policies, the procedures, the monitoring, the testing in place. It is truly a results-based approach to examination and supervision to make sure that you are carrying out that program. FinCEN is also, as part of this, encouraging responsible development, innovation, and integration of technology. And that includes artificial intelligence, right? FinCEN is basically saying, explore the resources that are out there in order to make sure you have BSA compliance and see how they can fit within your program. Noteworthy here, NCUA, FDIC, and OCC did issue a joint proposal on AML, CFT amendments, kind of hand in hand with FinCEN's proposal. Both of these require programs to be written and approved by the board, an equivalent governing body, or appropriate senior management. And so that's kind of a new flexibility that's being proposed, because prior to this, it was only board approval that was required, but now there's a little more leeway. So what is your takeaway from this? Many of the underlying, processes, procedures, things that you have been doing as part of your BSA program are not changing. However, there is more of an emphasis now on implementation, and certainly more of an emphasis on your risk assessment and understanding exactly where your institution falls. So make sure that you are preparing and thinking about how you are going to map your risk assessment to those FinCEN principles, and also making sure that you have proper responsibility and accountability for carrying out the implementation of your program. Okay, so that is FinCEN, that is AML, CFT. We're going to switch gears a little bit to lending, and we have a CFPB final rule for ECOA. Jenna, what happened there?
Yeah, so the CFPB in that final rule is adopting three major changes. First, we have the removal of effects test language from Regulation B and its commentary, replacing it with a new statement providing that ECOA does not authorize disparate impact liability. Now, as you remember, disparate impact theory, under that, plaintiffs can challenge facially neutral policies that have disproportionately adverse effects on protected groups, even without proof of intentional discrimination. Now, here, the Bureau's reasoning centered on the statutory text of ECOA itself, which does not explicitly authorize disparate impact claims or contain effects-based language, but that's similar to other statutes where the Supreme Court has found that such claims are permissible. Now, second, the rule narrows what constitutes prohibited discouragement of credit applicants. Discouragement is now defined as a statement, meaning spoken or written words or visual images, that a creditor knows or should know would cause a reasonable person to believe that the creditor would deny their application or offer less favorable terms because of a prohibited characteristic. Now, there's a few key changes there. The prior reference to acts and practices has been removed, meaning that routine business decisions like branch location, where to advertise, or where to host community events no longer constitute prohibited discouragement on their own. The rule also updates the commentary to add examples of statements that are not prohibited, such as statements supporting local law enforcement, neighborhood due diligence recommendations, and financial literacy encouragement. Now, third, the rule significantly tightens the standard for special purpose credit programs. Now, the rule prohibits for-profit special purpose credit programs from using race, color, national origin, or sex as eligibility criteria. Existing credit already extended under prior special purpose credit programs using those characteristics is grandfathered, but new extensions of credit on or after the effective date of the rule is going to have to be in compliance with the final rule. Now, for special purpose credit programs that use other permissible protected characteristics like age or marital status, new conditions are going to apply. The written plan now has to include evidence of the program's need, an explanation of why eligible participants wouldn't receive credit otherwise, absent the program, and why where any prohibited characteristic is being used, a per participant showing of why that characteristic itself is preventative of credit access. Now, the rule is effective July 21st of this year, and institutions should begin their reviews, but don't forget that disparate impact liability theory has not been eliminated entirely. Claims under the Fair Housing Act and state-level claims can still be brought against institutions if there are violations, and there are likely to be legal challenges, so remain vigilant.
Thank you, Jenna. Yeah, great advice. Always interesting when the agencies are acting to change something that is allowed by law. So we'll have to see what happens there in the judicial sphere. Okay, next up, it's crazy that a year ago, it's already been a year that we had the rollback of all of that guidance under the executive order. I think now we have some additional guidance being rescinded, this time from HUD. Cheryl, what is being taken a look at there?
Right. So, we know that HUD enforces the Fair Housing Act. And over the years, HUD has built up a body of guidance surrounding the act. It's not been any formal rulemaking, just guidance. It told institutions and housing providers, here's how we read the Fair Housing Act, and here's what compliance looks like in practice, and here's how we intend to use it in our enforcement authority. So institutions have been relying on this guidance to build up their compliance programs, to train staff, and to defend their practices. So due to the recent executive orders, however, focused on deregulation, HUD has reviewed its guidance library against a three-part test. So the first test is the guidance statutorily required? Is it consistent with the actual text of the Fair Housing Act, and does it reduce compliance burden? Well, HUD determined that 8 guidance documents failed at least one of those tests. So the guidance was pulled from HUD's website, and HUD also issued a formal Federal Register notice in April listing the withdrawn documents, which we captured in our Incomply library. The effective date for the withdrawal is September 17th of 2025. Now, of the 8 documents that were withdrawn, 6 primarily affected housing providers and landlords, but I do want to focus on 2 very briefly that lenders have historically relied on. The first is guidance on digital advertising. So it existed because as institutions shifted to digital advertising, AI and algorithmic-driven ad delivery created a new problem, which was discriminatory outcomes that would have outcomes that would happen even without intent. So if an algorithm deciding who sees your mortgage ad could effectively exclude protective classes based on how it learned and not because anyone designed it to. So HUD issued this guidance to put institutions on notice that the Fair Housing Act applied in that space. But even though the guidance is no longer in effect, the Fair Housing Act's prohibition on discriminatory advertising still applies. Also, remember that state fair housing laws will be in play and private litigation still remains a risk. The second piece of guidance I want to focus on is the statement on Fair Housing Act and special purpose credit programs. The guidance said that special credit programs that are structured under ECOA and Reg B generally would not violate the Fair Housing Act. Well, HUD has withdrawn that guidance as well. So if your institution cited it as in your compliance documentation, for example, or in your fair lending policies, or even your marketing materials, just make sure that you update those materials and those policies. And then another key takeaway here is just make sure that from now on, your fair lending framework is based on the Fair Housing Act's actual statutory text.
Perfect. Thank you, Cheryl. Yeah, fair lending, definitely one of the more touchy subjects here, and one that you may want to make sure that you're aligning with what the regulators say, just as kind of a best practice. Okay, we have a new development in a case that we have talked about for a long time. Jenna, what is that most recent development?
Yeah, so the DOJ is going to implement its $68 million settlement with a development company as a private agreement now, bypassing court oversight after a federal judge has raised concerns. Now, the deal would resolve redlining and predatory lending claims, requiring $48 million in infrastructure improvements and $20 million in law enforcement and public safety spending. Now, the court had questioned whether or not the settlement was appropriate, the structure of it was appropriate for a fair lending case, and viewed the provision allowing 20 million in law enforcement allocation for immigration enforcement as problematic, and noted that the previous lawsuit never mentioned a request for additional police activity. The judge had also cited a lack of monetary penalties for the violations and the failure to provide monetary relief for the impacted borrowers. Now, an attorney for the development company has stated that the company will offer relief options for borrowers through the agreement, including up to 4 months of interest free forbearance for those that are experiencing financial hardship. But it remains unclear who would be eligible for the program, how long the program would run, and it doesn't guarantee any direct monetary recovery for those impacted individuals. Now, an attorney for the National Fair Housing Alliance had stated without the judge's approval on the settlement agreement, the parties are left to oversee the terms on their own. And it leaves the door open for residents to challenge the settlement since it doesn't have the full force of the law behind it. Now, it's an interesting precedent to set here with the DOJ when we think about it. Enforcement actions are typically a multifaceted tool. They are used to punish past violations. They're an opportunity to make corrective actions and prevent any future issues. And they're also meant to provide restitution to harmed individuals and make those individuals whole again. But with this sort of resolution, the consumer's ability to be made whole again has kind of become a forgotten piece of the puzzle. So we now will wait and watch to see if there is a challenge, and we will keep you updated if any more updates come from this case.
Thank you, Jenna. Yeah, I think as when we initially reported the settlement that was announced, we thought that that $20 million in law enforcement public safety spending would potentially be an issue, and I think we see that now. All right. Talking about the administration, another focus is the Military Lending Act and protection of veterans and service members. And so we saw some, backup of those words with a recent consent order by the OCC. Cheryl, can you give the specifics on that consent order?
Yeah, sure. The OCC entered into a consent order with a bank out of Chicago over its VA cash out refinance loan marketing practices. So VA cash loans involve, were eligible veterans and service members. They allowed them to refinance their mortgage by tapping into the equity in their home. Well, what happened in this case was that between 2022 and 2024, the bank sent out advertisements to customers telling them they had available funds and to contact the bank. But the letters were actually just solicitations for VA cash out loans, and a new loan would be required in order for the customers to actually access the funds. Bank employees also told customers that the bank had a special relationship with the VA, which it did not, and that refinancing would significantly lower the consumer's interest rates in monthly payments, which it did not. So customers ended up paying higher rates than they had been paying before. So the OCC found that they were in violation of Section 5 of the FTC Act, which prohibits deceptive acts and practices. So the bank is now going to need to hire an independent third-party restitution consultant to identify affected customers and determine the appropriate amount for restitution. And what's interesting in this case is that deceptive marketing surrounding VA loans have come up before. Back in September of 2020, during the first Trump administration, the CFPB ran a formal enforcement sweep and issued 9 separate consent orders against VA mortgage lenders for false and misleading advertising. And so the fact patterns in those cases are nearly identical to what happened in this case. So a major takeaway here, if you offer VA loans, make sure you're reviewing your loan marketing materials to assess them for any potential UDAP violations.
That is a great takeaway, Cheryl. All right, we are going to go ahead now and talk about some outstanding litigation impacting banks specifically. Man, both of these that I'm about to talk about would be very fun to work on. But the first one is dealing with preemption of the Illinois interchange fee Prohibition Act. That's the ILFPA. And what happened here is the OCC actually issued an interim final order stating that federal law preempts the Illinois Interchange Fee Prohibition Act. And so, just as a reminder, that act prohibits financial institutions from charging interchange fees on the sales tax and gratuity portions of credit and debit card transactions. And in February, we actually had a federal district court rule that Illinois is permitted to regulate those types of fees. And while, an appeal is likely coming, the OCC is attempting to use its power under 12 USC Section 25B to basically say that national banks and federal savings associations are exempt from the ILFPA's prohibition because it is preempted under the National Bank Act. So, more than likely, we will see litigation also around this interim final rule because the OCC does have the authority to make a preemption determination, but it has to follow a similar analysis that a court would conduct to determine whether or not a state consumer financial law prevents or significantly interferes with the exercise by the national bank of its powers, right? It's not necessarily just because the OCC thinks that Illinois shouldn't be allowed to pass a law like this. There is actually a legal analysis that needs to be conducted. And keep in mind, when Chevron was overturned in 2024, that's basically the law that stated that courts would generally defer to agency interpretations of laws. When that was overturned, courts now give less deferential treatment to those agency interpretations, meaning that the OCC's reasoning could be under some intense scrutiny and ultimately be deemed unlawful. And kind of as a side note there, simultaneously to that interim final rule, the OCC also issued another one clarifying that national banks have broad authority to charge non-interest fees, including interchange fees from debit and credit card operations, whether those fees are set by the bank itself or third parties. And so this is one we are definitely keeping track of, the developments that are coming down, and we'll certainly keep you up to date here and in Ncomply. Okay, the next situation that we have is Oregon, out of Oregon. The state of Oregon just signed into law House Bill 4116 this past month, and that bill allows Oregon to reimpose their interest rate caps, which are generally about 36%, on certain loans made to Oregon residents and apply that broadly to consumer finance loans of $50,000 or less. And very important, it also expands the definition of where a loan is made to include the borrower's location, such as, where the consumer resides or where they entered into the loan agreement. And that is a big deal because it is now only the third state behind Iowa and Colorado to pass a law like this. And Colorado already has a lawsuit in the works for its law, which is currently waiting appeal in the 10th Circuit. And so really here, a ruling and eventually possibly a Supreme Court ruling could be huge for what has been the norm for state chartered FDIC banks over the last 4 decades. And that's the ability to export your home state's interest rate to a borrower in another state, just like a nationally chartered bank can. So that means, right, if I'm chartered in West Virginia and I make a loan to someone in Virginia, I can use West Virginia's interest rate. And so really the core legal question that the court needs to determine is whether a loan is made where the bank is located, since the bank is the actual one extending the credit, or whether it's made both in the bank state and the borrower state. And that would essentially give a pass to laws like Oregon's to cap rates charged by out-of-state banks. One of the things that this kind of raises is that other states may follow Oregon's lead, and a determination made by a court that these laws are permissible could force lenders to have to comply with varying rate caps or even make the decision to exit certain states and certain markets, really leaving state chartered banks disadvantaged versus national banks, right? That could really impact charter decisions and really put pressure on the dual banking system. One kind of note here that is important is that there was a federal law recently introduced. It is called the American Lending Fairness Act of 2026, and that would remove states' ability to pass opt-out laws like this. So something, again, we're watching. It is a huge part of how financial institutions operate is exporting the interest rates where their financial institution is located to customers in other states. So certainly something to pay attention to. Okay, reputation risk. We've talked about reputation risk a lot over the past multiple reg briefs. OCC and FDIC made some action here. Jenna, what happened with those regulators?
Yeah, so they had finally issued their final rule codifying the elimination of reputation risk from their supervisory programs. Under the rule, the OCC and FDIC may not criticize an institution, formally or informally, or take any adverse action on the basis of reputation risk. Now, adverse action is defined broadly, including examination findings, supervisory rating downgrades, and licensing denials. And the rule also prohibits the agencies from requiring, instructing, or encouraging an institution to close accounts, terminate business relationships, or refuse service to any person or entity based on their political, social, cultural, or religious beliefs, constitutionally protected speech, or involvement in a lawful business activity that may be deemed politically disfavored. The rule also defines reputation risk as a risk that an institution's actions could negatively impact public perception for reasons unrelated to the institution's financial or operational condition. And that carve out just allows the agencies to still address risks that directly affect solvency or service delivery abilities of an institution. Now, the rule doesn't impose any new compliance requirements on financial institutions, but it's important to remember that state regulators still have the ability to conduct examinations that include reputation risk components that could impact your institution, and that preserving customer trust and maintaining that strong compliance framework is going to be crucial for any growth and success for your institution. Customers still want to be sure that their hard-earned funds are protected. And I know I've recently just made a change, but they are likely to do some strong research before choosing who to bank with. So make sure that you are remaining vigilant.
Great advice. Yeah, reputation risk still an issue. Interesting that OCC and FDIC decided to kind of tag team and put two distinct areas into a similar rule, one being reputation risk and one being that debanking requirement or prohibitions. Okay, we also have model risk management, some revision of the guidance around that framework, and that is by the OCC, Federal Reserve, and FDIC, really clarifying that model risk management principles and establishing that it is a risk-based approach, right? I feel like that's probably the key phrase for this reg brief is risk-based approach. But with those revisions, the agencies state that the updated guidance is most relevant for institutions with over 30 billion in assets. You know, maybe take that with a grain of salt. Generally, a model that you have in an institution is a model, and that framework is going to be useful for it. Its function and the management of it doesn't necessarily magically change just because you hit a certain asset size. So from a best practice perspective, this is likely still applicable to financial institutions under 30 billion in assets. But the updates also include areas like the materiality of models to really distinguish between higher risk profile models. It changes the life cycle kind of provisions of modeling, and that includes removing explicit mention of testing, change management, and approval. It also removes a minimum annual validation review cycle requirement, broadens the expectation of monitoring to include monitoring of performance and limitations, And then also places no specific expectations on board, management, and committees with regard to model risk management, which was previously in the guidance. Of note, with these updates, the banking regulators did specifically state that generative and agentic AI fall outside of this guidance's scope, right? This is really dealing with models where it is very algorithmic and mathematical, and calculations are conducted with an expected result. Whereas AI that kind of learns, that machine learning is there and builds upon itself, is outside of its scope, and the regulators may pass some additional guidance to help give financial institutions information around how to manage the risk associated with that technology. Last one for banks is the FDIC's rescission of guidance around non-sufficient funds fees. That guidance that they rescinded warned of potential compliance and litigation risks that were tied to charging multiple NSF representment fees for unpaid transactions. And so it is important to note that this rescission doesn't necessarily mean that, those NSF representment fees are okay. The FDIC did specifically state that banks should review your NSF fee practices and disclosures to make sure that they are grounded in current law, not just the withdrawn guidance, and that institutions that change their practices in response to the guidance should really reassess whether those changes still make sense. I'll say one more layer on this to keep in mind is that states may have their own independent non-sufficient fund fee standards, and each state also has its own UDAP law. So a federal rescission of this guidance doesn't necessarily, clear the path at the state level. There could still be an unfair, deceptive, or abusive act or practice with these types of fees and other sources of compliance risk. Okay, we will move on to credit unions. We have another one that we've talked about a lot over the past multiple reg briefs, and that is NCUA's round of deregulation proposals. I think we've now officially moved outside of the normal 9 innings of baseball, and we are in round 9 and 10. Cheryl, what were kind of the most important pieces that came out of these proposals?
Yeah, well, we know, like you said, Robert, N2A has been methodically working through its regulations to eliminate requirements that it has determined are now obsolete or overly burdensome. So for the 9th round, N2A is proposing to amend its chartering and field of membership rules regarding associational common bond eligibility. So under current rules, N2A evaluates whether a group qualifies as a genuine association and therefore eligible in a federal credit union's field of membership by looking at certain factors. So if the association requires members to purchase a product or a service as a condition of joining, for instance, like the YMCA, then their eligibility would be automatically denied. But under the proposed rule, the purchase requirement does not automatically disqualify a group. So the NCUA would look at the association's structure and other factors surrounding its operations to determine if its relationship with its members is primarily or just incidentally a client-customer relationship. So again, the key question is whether the client-customer relationship is incidental or, the core reason for the group existing. The NCUA used an example of what would be something that may qualify using a fraternal order that also happens to offer insurance. So if the association offers the insurance but doesn't require its members to purchase the insurance, it may qualify as having a valid associational common bond. So the proposal, again, is intended to provide relief to single associational groups and multiple common bond federal credit unions of all sizes that are looking to include associations that may have a customer-client component. So the comment period on this one is already closed, but we will keep you posted once it's finalized. Moving on to the 10th round, it is proposing 6 changes to the rules governing the merger of insured credit unions into banks. So the goal is to give credit union boards more flexibility and reduce some of the administrative burden. So some of the changes include removing the clear and conspicuous definitions from 12 CFR 708 to allow credit unions the flexibility to design disclosures that are effective and clear for their members. It also includes replacing the requirement to publish pre-board vote notices in a general circulation newspaper with the requirement to post it on the credit union's website. So it finalized the process of converting or merging into a bank, becomes less prescriptive, and with more room for boards to structure disclosures and communications in ways that work for their members. There is still time to submit comments on that. You have until June 22nd.
Perfect. Definitely get those comments in if you would like to. That is the end of our reg brief. Thank you, Jenna and Cheryl. As always, if you are looking for a practical way to stay on top of your regulatory activity as it unfolds, please check out Ncomply. It is now enhanced with intelligent complaint management to help you spot issues within your institution earlier and to connect complaints to real compliance risk. Again, thank you for joining us for the reg brief, and we will see you next month.